Welcome back. For the next part of this session, we're going to be looking at different business forms for this week's content. When looking at different business forms, just appreciate that businesses can be broken up into sole proprietors, partnerships, CCs, and companies. So in chapter number 2, we're focusing on the characteristics. So for example, legal personality. Which forms of businesses have a legal personality? So sole proprietors don't, partnerships don't. CCs and companies do. CCs and companies, they're called separate legal entities. They have legal personality because those separate legal entities will exist standalone without any changes in ownership. Okay, so if I have a sole proprietor, if the sole proprietor dies, so does the business. Same with a partnership. If the partners die or change or retire, the partnership actually closes, inverted commas, okay, and a new partnership agreement needs to be created. Okay, so just remember, with different forms of businesses, you do need to identify whether it is actually a legal personality or not. Starting procedures, sometimes certain businesses require more administration and they require more time, effort, as well as contracts and procedures that need to be put in place to make sure that the business is legally created. Okay, so obviously you need to register a business with a CIPC if we're looking at a company or even a CC. Remember, new CCs cannot be registered, but the existing CCs still continue. Right, so that's something to consider when looking at the starting procedures. Obtaining capital, certain businesses have access to more capital because they have shareholders that they can approach to buy more shares in a particular company. Obviously, a sole proprietor would have the least access to capital, and obviously the most access or the easiest form of raising capital would be selling shares in the JSE, and companies, public and private companies, are able to sell shares. Obviously, public companies can sell shares in the JSE, private companies cannot. All right, let's have a look at the next section. Here we're looking at ownership and management for those different types of businesses. So if I'm looking specifically at a sole proprietor, the owner of a sole proprietor would be the owner. The owner of a partnership would be the partners. The owners of a CC would be the members. The owner of a company would be the shareholders. So when we look at ownership and management, remember from chapter 1 we spoke about the agency problem. Sometimes owners and managers aren't always the same people because you might have owners like shareholders that give management to managers to take care of. Okay, so when looking at ownership and management, they're linked. Sometimes they're one and the same. Sometimes there's a bit of overlap. Sometimes it's completely separate. It all depends. Just remember, when looking at ownership and management, if you give away more ownership of your business, you obviously lose some of the control. So that's something that you always need to consider when starting a business or when running a business. How much control do you actually want in the business? If you've got ownership of the business, you can vote and you can choose in terms of what actually happens in the business. Distribution of profit, all businesses should focus on making sure that their income is greater than their expenses. We know that the primary goal shouldn't be profit. If they do make profit though, they are able to distribute a portion of it to their shareholders or their owners. If I'm distributing a portion of the profit to a shareholder, we call that a dividend. That's quite a common term that's used when looking at shares. Okay, shares often have dividends. They don't always do, but in some instances, some companies can choose to distribute a profit, right? And that will be a share of the profit to the owners. Income tax, companies, individuals, everyone basically has to pay their fair share of taxes. So when we look at income tax for a company or a form of business, certain businesses that are separate in terms of the legal entity, so CCs and companies, Pty Ltd and Ltd, okay, public and private, they're all required to pay tax as a juristic person. Right, so a CC will pay its own tax. A company would pay its own tax, right? And then individuals and partners, obviously, they would pay their own separate individual tax. So just remember, when looking at income tax, depending on the structure and the type of business, you could have a scenario where the business itself would have to pay its own taxes. In this book, the focus is obviously going to be on a sole trader. So don't worry too much about partnerships, CCs, and companies. Just remember that in this textbook, when we continue going through more content, you'll see the focus is primarily on a sole trader. So in other words, one individual running a business. Anyone can start a business. A sole trader is very easy to start, right? As long as you're paying your taxes and you're declaring income and you're making sure that SARS is informed of your trading activities, then you are a sole trader. So all of you could start a business tomorrow. You could start a butchery, you could be a florist, you could be a plumber, you could be an electrician, you could be a spaza shop, you could be a corner cafe. Those are just some examples of different types of businesses that would be appropriate, okay, for a sole trader. Okay, something small. We're not talking about large corporate businesses like Naspers or Process. That's business on a whole different level. Okay, here we're focused on more smaller businesses where you have one owner, right? One owner owning the business, one owner responsible for the business. Right, please have a look at this example. It's quite a nice example, just highlighting some information regarding taxes that you would have to pay as an owner. If you look at the different fields of accounting, just remember we spoke about management accounting versus financial accounting. The textbook now covers this topic in detail. If you look at the heading here for 2.6.1, you can see we have a note here regarding financial accounting, which we said earlier was the external reporting. And if you remember what we spoke about in the previous video, external reporting is summarized. Okay, so it's easier to interpret, it's less detailed. Management accounting, let's just choose another color, is detailed and it's internal. Internal accounting. All right, so internal accountants, okay, internal accountants are called management accountants, and those management accountants are looking at the detail. It's very specific. It's looking at a breakdown of all the detailed accounting information for that particular company. Okay, financial accounting is a lot more summarized, and financial accounting also follows IFRS. Remember we said IFRS is the international rules, all right, that everyone that follows the rules needs to comply with. With management accounting, there is no rules. Okay, managers can decide how they want to show that information because only managers are going to see it. It's internal. If it's external, then it needs to be very, very, very specific. So please have a look at what the textbook has provided you here with. 2 branches of accounting. They've even given you a bit more detail regarding what we have just explained. Okay, the one is more detailed, the one is more summarized. The one is used externally, the one is used internally. Here's a really, really great summary highlighting the differences. Okay, you can see that with financial accounting, you're reporting to outside organizations or individuals, okay, investors, shareholders, lenders, SARS, regulators, etc. When it's management accounting, it's inside, okay, internal. Financial accounting, it summarizes information, okay. Here, it's more detailed. It's looking at emphasis on very, very specific items. So just be aware that when you're looking at the differences between financial accounting and management accounting, the one is obviously more objective and the one is more subjective. Subjective because, remember, managers can decide how they want the internal records to be accounted for. Financial accountants don't have a choice. They have to follow IFRS. That's very important to note. Okay, here they don't need to follow the accounting framework because it's management accounting. It's inside the business. Only the managers inside are going to see that information versus financial accounting where everybody is going to see that information because it's reported to external users. So please have a look at the summary. It's a really, really great summary to contrast the differences between financial accounting and management accounting. Just something else to consider in the next section, you're looking at the importance of management accounts in the management of an enterprise. We know that businesses have managers that are required to provide certain functions. So if I'm focusing specifically on the financial side of things, when looking at management accounting, managers need to make sure that they're planning, that they're organizing, that they're leading, and they're obviously controlling all the different aspects of a particular business. So management is an incredible tool for being able to make decisions because it's detailed and it covers all areas of the business, and that's what we're going to be requiring if we're looking at the internal management of the business. I'm sure all of you will agree, if you think about your lives, okay, as individuals. Okay, as an individual, hopefully you have a plan, okay, you have some sort of goal. Hopefully you're organized, okay, so there's some level of organization in your life. Leading, okay, how do you lead, okay, in terms of your actions and guidance, okay, and then control, right? Obviously, in terms of life, there are certain things we need to control, there's certain things we need to manage, and that's obviously going to affect our performance, right? So if we relate that to a business, the business does the exact same thing. A business needs to plan, a business needs to be organized, a business needs to be able to lead, and a business needs to be able to control, right? Those are very important things that a business needs to do in terms of its functions. When we're looking at how they do it, management accounting helps them with that because management accounting is detailed. So if you know which products are selling, let's use an example. Let's assume we have 4 different products: product A, product B, product C, and product D. And let's assume we have detailed information regarding those products. We know that product A generated, in terms of, let's say, revenue, maybe 100,000. Product B, 200,000. Product C, 300,000. Product D, 50,000. Okay, so based on the information that we have, obviously, if you were inside the business, if you were internal, okay, management accountants are internal, they would be able to look at each product and they could analyze the product and they could analyze maybe the profitability, maybe the operational costs that go into producing each product, and they could decide maybe this product we need to scrap, this product we need to expand on, we need to make more of it, this product will continue manufacturing the same amount, and this product will also scrap. Okay, I'm just using that as an example. Decisions have to be made based on information. And that's why this is so important. Management accounting provides us with that information. And if we have that information, we can make better decisions. So when you look at the textbook, you'll see there's a few other notes regarding management accounting taking factors into consideration. Right, so what do we need to consider when we're looking at planning? If we're looking at planning, obviously the plan needs to take the internal environment into consideration as well as the external environment. Internal would be within the company. So for example, how much resources does the company have? Where is the company located? External environment would be things that we can't control. Right, so I hope all of you had watched the budget speech. The budget happened yesterday, actually. I'm obviously filming this on Thursday. Yesterday was the 24th of February, and that's when the national budget was delivered by Mr. Tito Mboweni as the finance minister. So can we control what government is going to do? No. Can we control taxes? No. But as a business, as an individual, you need to pay your fair share of taxes. Okay, it's a legal requirement for everyone in the country. So external environment, things we can't control. Can you control the rand-dollar exchange rates? No, you can't. Can you control the rand British pound exchange rate? No, you can't. Okay, or the euro? No, you can't. All right, so currencies can't be controlled. The economy can't be controlled. Okay, can you control the economy? No, you can't. Right, can you control the taxes? No, you can't. Okay, so the point I'm trying to make is that when you're looking at planning, factors that will affect planning could be internal or external. Internal factors are things that you can control. An example would be you control how much material goes into manufacturing a particular product. You determine what the characteristics are. Okay, you determine what the design is going to look like. Okay, that's all internal. Those are things you can control. Things that you can't control are considered outside, okay, part of the external environment. Emphasis is always on the future because we're looking at planning. Okay, planning is about the future. What is your plan? Right. In the future, you're going to be writing your assessment. What is the plan? How are you going to prepare? How are you going to study? How are you going to manage your time? There's a lot that you need to consider as part of the planning process. And that goes with everything. Okay, when I'm looking at the future, there needs to be a plan. And that's no different when you're looking at finances. Okay, with finances, with financial management, or with accounting, it's important to plan. If you don't have a plan, then you're going to fail. Okay, there's a saying that basically says to fail. I think. Let me just try to think of it now. Not having a plan is planning to fail. That's it. Not having a plan is planning to fail. Right? If you don't have a plan, you're going to fail ultimately. Right? You might have some good luck. Okay, but remember, luck is up to chance. Okay, no one wants to live life based on luck. Okay, you make your own luck because you plan. Okay, the more you plan, the better. Right? So if you don't have a plan, you're actually planning to fail. So businesses that plan do well. Businesses that plan can be successful. Businesses that plan can create more value. Businesses that plan can create more profits. Okay, if we continue going through the rest of the theory in this particular section, you'll see there's quite a lot of theory just discussing businesses' role in terms of the requirements that they would have to consider when looking at these different roles. Okay, so planning is important. Data must be flexible and relevant. If I'm looking at planning, I need to have good sets of data, information, valuable information that I can use to make good decisions. Timeliness of information is very important. Okay, you don't want information that's outdated. If you are a manager, let me ask you this question. Okay, for those of you that are working full-time and studying part-time, as a manager, okay, or as an employee, right, do you want information that's relevant to today or relevant to now, or do you want outdated information? Right, or here's a simple example for all of you. If I had to give you a timetable for last year's classes, would that be relevant? Would that be useful? Definitely not. Okay, we're not living in 2020. Okay, it's 2021. We need a new timetable. We need a timetable for this year. That information would be timely information that's relevant, that's new, that's current. Okay, so just remember, when looking at decision making, the information needs to be as updated as possible. Okay, as up to date as possible. All right, please have a look at these activities. They're really, really great activities for you to practice your overall understanding of the theory that we've covered in these videos. Please remember, these activities we can address in more detail when we have those live sessions. So please do these activities on your own. You do have solutions to these activities as well at the back of the textbook, and you can use that to check your progress to see if you're on the right track. If you do still have problems with any of these questions, please use Cole Campus to communicate with me so I know what the problem areas are, and I can respond to you either on the platform or via WhatsApp or when we have live sessions. Okay, the last few pages of this particular chapter covers a little bit more detail regarding accounting. So when focusing specifically on bookkeeping, we need to understand what the process is. There's something called an accounting cycle. The cycle is done throughout the year because every business needs to report on the financial transactions that took place during the financial year. So we have a 12-month financial year, and during the year, bookkeepers, accountants are going to be following a specific process. The process is given to you in a nice laid out diagram here. I just want to put some numbers next to each of the steps. Step number 1 is the transaction. We need a transaction to take place, so buyer and seller enter into a transaction. Second step would be to record that transaction, to have proof. So we call that a source document. Okay, an example of a transaction could be buying a textbook. Okay, if I'm buying a textbook from a store, okay, what am I going to need to do? I'm going to have to make a purchase. Okay, so I'm making a purchase, I'm buying a textbook. What source document will I get? I'll get a till slip or an invoice. That could be step number 2. Right, now we need to follow the process. What's the next step? Well, from an accounting point of view, from a bookkeeping point of view, step number 3 is the journal. What is a journal? It's a book that summarizes, that summarizes all the source documents. Okay, so all my invoices, depending on what type of purchase I made, was it a credit purchase or was it a cash purchase? Right, if it's a cash purchase, then I'll have something called a cash receipts journal. Okay, and that we'll look at in a later chapter. Okay, I don't want to bring in too much of that yet. Remember, we're only looking at chapter 2, still part of the introduction, still getting into the detail regarding accounting. All right, next step would be the general ledger. Okay, the ledger. Ledgers. Okay, a ledger, a nice word or a simple word for a ledger would just be a list. All right, so it's a list summarizing the journals. Okay, you can see it's a step-by-step process. Step 1, step 2, step 3, step 4. Next step is a trial balance. And then the final step would be your financial statements. The last step here, I'll move this down, but I think you can see some of it. Statement of profit and loss and other comprehensive income, financial statements. Okay, you do get other financial statements, a statement of financial position, the statement of changes in equity, and even a cash flow statement. Okay, you don't have to worry too much about all the different statements. As long as you have an idea of what a financial statement is, that's important, okay, that you need to know. All right, and that's the process. You've got 6 steps in the accounting cycle. I've tried to highlight the main words. Okay, remember, this is your textbook. Use the textbook. Highlight, circle, underline. Make your studying as simple and easy as possible. Okay, you have 2 more activities for you to complete. The one looks at some history regarding accounting, and the other looks at more descriptive definitions regarding your key concepts, accounting, bookkeeping, and is there a difference? Okay, this is something we can describe and discuss on Cole Campus as well as in our live session. All right, and then the last bit in the textbook here just highlights a few notes for the next chapter. Okay, so if you're looking at transactions, we're going to be covering more of this in chapter 3 and 4, okay, and later on in the textbook. So to start off simple, transactions are, let's call them events. Events that take place where you have an exchange of something. Right, so these are all different types of transactions. If the owner contributes cash to the business, that's a transaction. If the owner withdraws cash or other from the business, that's a transaction. If the customer, okay, buys something and we have a cash sale, that's a transaction. If they buy something and it's a credit sale, that's also a transaction. So you have different types of transactions, and those transactions will be coming up in your next chapter when we're actually going to be analyzing these transactions. For now, I just want you to appreciate that certain types of transactions can be grouped. Okay, remember, I don't only sell to one customer, I can sell to many customers. If I'm selling to them for cash, I've got cash sales. That's the group of transaction. Same with payments. I don't only pay one supplier, I can pay many suppliers. And I can buy different things. I can buy merchandise, I can buy other. It just depends what I'm purchasing. But a purchase or a payment using cash is just that. It's a purchase, okay? It's a cash transaction, okay? It's a payment. And then I can have receipts as well, right? So they're just different groups of different types of transactions. All right, and then the textbook ends just with a few notes regarding theory. Let me just clear the drawings on screen. What is a source document? We spoke about it earlier. Okay, proof that a transaction has taken place. So we have paper-based or electronic records that keep track of things. And that could be something like an invoice. It could be something like an EFT, a confirmation, a check counterfoil. Those are documents that record transactions. Okay, so a till slip would be a transaction source document. What is a journal? We spoke about it earlier. It's a special record-keeping book that's used to group transactions. Okay, similar transactions are grouped into a journal. Right, so we have different journals. We have a cash receipts journal and we have a cash payments journal. Those are the 2 cash journals. We'll look at those later on in one of your chapters. Right, so just remember, a journal groups transactions. That's it. A bank reconciliation, also something you will do in a later chapter. A bank reconciliation is a process of checking. Every month, you're going to be checking your accounting records. You're going to be confirming, do you agree or disagree with the transactions on your bank statement? That's a bank reconciliation. It's a process of checking. What is a general ledger? It's a list of accounts. It's a collection of accounts. A list or a collection of accounts. What is a trial balance? A trial balance is a list of accounts where you're looking at the balances, the debits and the credits. Okay, this is something that we looked at briefly in terms of the accounting rule. Okay, every debit has a credit. We will look at that in more detail when we cover the specifics regarding the rule for every debit has a credit. Okay, so for now, just appreciate that a trial balance would be a list of accounts. Okay, so a list, and then you would have a debit and a credit, and you would have to add up and you'd have to check, do your debits equal your credits? That's what a trial balance is. Right, it's tabulated, it's in a table format, and it's looking at debits and credits to make sure everything balances correctly. The statement of profit and loss and other comprehensive income looks at income minus expenses, so you're showing the profits. Okay, you're looking at income and expenses and what the performance looks like in the business. Did we make a profit or didn't we? Did we sell lots of goods during the year, and how much expenses did we have? Right, and then the last bit here is the statement of financial position. Right, this I've actually spoken about when we looked at one of our previous sections where I spoke about assets and liabilities for a company like Naspers or Twitter or any other company. If you've got more assets than liabilities, if your assets are greater than your liabilities, if you've got 2 million in assets and 1 million in liabilities, are you in a good or bad position? You're in a good position. Okay, versus if you had, let's say, 3 million in assets, but 4 million in liabilities. All right, obviously your liabilities are greater. All right, so that would be a bad position. Why? Well, do you actually own those assets? No, you don't, because you have so many liabilities. All right, so just remember, it just depends on the situation. Okay, you always want more assets than liabilities. We'd much rather have 5 million in terms of assets and maybe 2 million in terms of liabilities. See, that'll be a good position. Okay, so just appreciate that a financial position is exactly that. It's looking at a list of balances. Okay, there's an error here. It's not income and expenses. Okay, it's assets and liabilities. Okay, if you look at the statement of financial position, it's a list of assets and liabilities, not income and expenses. Income and expenses was for the statement of comprehensive income. Okay, so a slight error there, so please just update and adjust that to make sure that you have the correct definition for the statement of financial position. And then you've got more activity questions. These are multiple choice questions, so really great for you to practice in terms of choosing the correct answer. And then the last part is just a note regarding how accounting systems in today's world are all computerized. Okay, this is purely additional information. None of you are going to be practicing accountants. That's not the purpose of this course. The purpose of financial management is to provide you with the skills to make good decisions as a media executive. So this is just nice to know because you will be dealing with accountants and bookkeepers when you're running a business, managing a business, or working at a business. And these are just some of the packages that are used in reality to keep track of all those accounting records. Please have a look at the conclusion and summary just to make sure that you're comfortable with the content that was covered in chapter number 2. Thank you for watching. See you in the next video.